Okay, let's unpack this. Have you ever been like a passenger in a car,
Oh, yeah.
typing out a crucial text message, and you hit send exactly as you drive into a tunnel?
Right, the worst timing.
Yeah, so the message exists on your phone, you click the button, but its actual delivery is completely at the mercy of this unseen lagging infrastructure.
Right.
And today's deep dive is about that exact phenomenon, but in financial markets. We're looking at a stack of recent research notes and technical articles on fast-moving markets to uncover the hidden gap between, well, the moment you click buy on a trade and the moment your order actually reaches the matching engine.
It's a mechanical reality every trader faces. But the sources we're reviewing today highlight how ignoring this microsecond life cycle of a trade it can turn a winning strategy into a structural loser.
So taking that text message tunnel analogy,
Yeah.
just how long are we stuck in the dark here? Because a round-trip delay in trading isn't just about, data hitting a server, right?
Right, far from it. We're looking at a multi-leg journey that's measured in milliseconds. So the price, quote, travels from the liquidity provider to your platform.
Okay.
Then you process it, you click, and the execution request travels through your local network across the internet into your broker's environment.
Wow.
And finally, a confirmation routes back. So it's a whole process.
Which, feels instantaneous to us humans, but for the algorithm sitting on the other side, a 50-millisecond delay is basically an eternity.
Exactly. What's fascinating here is what happens inside the order book during that specific window.
Like during a major news event.
Yeah, especially during a high-impact print like a CPI release on the Euro USD. The liquidity you saw on your screen when you clicked buy, it doesn't just move.
Right.
It completely evaporates.
Wait. I want to push back on that a bit. If I click buy at a specific price, aren't brokers essentially on the hook to honor that quote they just flashed on my screen? Why is the retail trader eating the cost of that delay?
Well, because the broker isn't holding that liquidity in a vault for you.
Oh, I see.
Right. They are routing your order to a market that is constantly repricing. In the text, they actually reference the 2015 Swiss franc flash crash.
Oh, yeah, that was massive.
Yeah. During extreme events like that, high-frequency algorithms consume the available liquidity at the top of the book in microseconds. So by the time your delayed order arrives, the matching engine is forced to fill you at the next available tier.
Which is often significantly worse, I'm guessing.
Yes. Your MT5 client is literally sending an execution request to a ghost quote that expired 50 milliseconds ago.
So if my local hardware latency exponentially compounds the slippage, my immediate instinct is just like, call my ISP and pay for the absolute fastest fiber optic pipe available.
Right, the gigabit speed.
Yeah, if I have gigabit speeds, I beat the algorithms, right?
Actually, that is a massive misconception.
Really?
Yeah. Bottlenecks are systemic. Upgrading your router doesn't solve the fact that your CPU might be throttling.
Oh, because of the trading software itself. Exactly. Platforms like MT4, MT5, or CTrader, they aren't just sending simple text commands. They are constantly processing massive tick-by-tick data arrays.
To update custom indicators and stuff.
And render charts in real time.
So meaning if my laptop is struggling to, render a 4K video in the background while I have 30 browser tabs open, the trading platform drops data packets, so my execution gets queued behind Spotify.
Exactly. If we connect this to the bigger picture, this is where traders conflate latency, spreads, and slippage.
Okay.
Because as we know, slippage is unavoidable during volatile prints.
Right.
But the research stresses that even with zero network latency, a choked local processor delays the outgoing signal.
Wow.
You can have the fastest fiber in the world, but if your machine is gasping for air, you are artificially widening your own execution gap.
So what does this all mean? If I'm sitting down to prep for a session, and I know I can't magically outrun a news event or force the order book to hold my price, how do I actually mitigate this?
Well, the sources outline a few non-negotiable steps. First, eliminate the wireless variables.
So plug in directly.
Yeah. Use a hardwired Ethernet connection for your primary workstation. Second, isolate your trading environment. Close out unused background software.
No more Spotify.
Right. And most importantly, if you are running expert advisors or automated copy trading tools, you have to benchmark them in a demo environment first.
Oh, to see how much compute drag they add to your platform?
Exactly.
So it sounds like this is heavily dependent on the type of trader you are. Like a scalper operating on the 1-minute chart needs this pristine, optimized environment because they are hunting tiny structural inefficiencies.
Right. While a swing trader shouldn't let an obsession with millisecond latency distract them from their overall trade selection.
Because they're holding it longer.
Exactly. If you're holding a position for 3 weeks, a 40-millisecond delay on entry is just statistical noise. The tech has to match the time frame of the strategy.
So it's really about auditing your vulnerabilities before the volatility hits?
Precisely.
Yeah.
And this raises an important question for anyone listening. The documentation explicitly warns that this hardware-induced latency can cause your connection to freeze entirely during massive order flow spikes.
Oof. Which would delay any attempt to modify a stop loss.
Exactly. Therefore, if a trader relies on manually exiting positions during major news releases, are they actually trading a setup, or are they unknowingly gambling their capital on the real-time processing limits of their computer?
Wow. That is a terrifying but incredibly necessary thought to leave off on.